Welcome back to Proper Wealth with me, Paul Mahoney. Today we're going to be talking about the current UK property market, some of the changes that are occurring, and how that's affecting both the market itself and the people involved. I have Ben Wilson from Best Buy to Let joining me. Thanks for joining us, Ben.
Thanks for having me, Paul.
So, Ben, the current market, I suppose let's start on some of the changes. There's been quite a few.
There have, yeah, absolutely.
Which is causing some uncertainty, I'd say. Perhaps if we just touch on what those changes are to start with.
There are a number, and there have been over the last few years. There have been a number of different changes to the stamp duty brackets, as well as the additional 3% stamp duty. There have been changes to the portfolio, the mortgage size, if you're a landlord and own numerous properties, and the tax changes obviously as well.
Okay. Yeah, so I suppose firstly the mortgage interest deductibility for buy-to-let mortgages. We then had the 3% stamp duty premium.
Yeah.
We had some changes with regards to the way that lenders look at mortgage serviceability, and then most recently some change with the way that lenders look at portfolio landlords. So I suppose they're the four big ones. A lot of people probably don't know how that's going to affect them specifically.
Exactly, absolutely. I think it's important a lot of landlords don't know. It's just that, it's the fear of the unknown. And I think it's important that people read up and get to know what's what and what's going to affect them and what's not going to affect them.
Yeah, okay. Well, let's start with the mortgage interest deductibility. How is that affecting things?
Well, before you used to be able to deduct the mortgage interest from the full mortgage interest amount from your taxed, so it used to be fully tax deductible. And now some of it is tax deductible. It's being phased out slowly but surely, depending on what tax bracket you fall in, and there are various different ways it's going to affect you.
Yeah. So that started this year, didn't it? The phasing in.
It is. Yeah, absolutely.
So I suppose people would just start to feel those changes and how it's going to affect them at the end of this tax year. With these complexities, I suppose advice is becoming more important, isn't it?
It is, yeah, and it depends how highly leveraged you are and what sort of yields you're achieving. And some people are going to be quite heavily affected, and other people probably not so much at all. It's probably the medium landlord, the landlord with sort of 5 to 15 properties, is going to be most affected. The landlord with 1 or 2 probably not so much, and the landlord with 20, 30 plus properties, again, not so much, because they're not going to feel the pinch quite so heavily. But it's the medium landlord who's really going to feel the pinch, I'd say.
It's a good point, actually. So you spoke about leverage and how that affects that change, and also people's tax position. I think a common misconception with that particular change is that mortgage interest is just no longer tax deductible at all.
Yeah, which isn't the case.
Which of course isn't the case. And for those that are on the basic rate of tax, a lot of them won't actually be affected.
No, not at all.
And I think perhaps that's due to the way that the change is worded. And also the way it's been sort of portrayed in the media.
Yeah, absolutely.
So understanding how that particular change is going to affect an individual is probably pretty important.
For sure. I think it's a fantastic headline to say we're scrapping mortgage interest completely. When, like you say, it's not that. It's just delving deeper into it and making sure you fully understand it.
Yeah.
And that's why I say the landlord with 1 or 2, it probably isn't going to jump into the higher tax bracket, and therefore not affected so much. But if it suddenly pushes you into a higher tax bracket, that's where it's really going to hit you.
Yeah. Okay. So that's the first change. We then spoke about the second change. So a 3% stamp duty premium for any property purchases beyond your first. How do you think that's affecting things?
I think depending on where you are and what you're purchasing. Now, if you're purchasing something at over £500,000, it really hits you in terms of the amount you're paying. An extra sort of £15,000-20,000 plus on a transaction really eats into your yield or your return. If you're purchasing something at a lower end of the market, an extra few £1,000s you can probably swallow. So it really depends on what price point you're purchasing it.
Because it's on top of the current threshold, isn't it? So as they increase with the higher value properties, the extra 3% starts to hurt more and more.
Exactly, and the new brackets that came in about 3 or so years ago meant anything below £1 million you generally saved a little bit of money on, and anything above £1 million it really hit you quite hard. So obviously if you're purchasing something at £1 million plus as a rental property, and you got an additional 3% or say £1 million, it's actually £30,000 on top of that, it's a huge amount of money to be paying for one transaction, and in my opinion probably doesn't make sense in most cases.
Yeah, okay, so I suppose the higher value properties are being hit most. whereas the lower value properties doesn't hurt as much.
Exactly that. I mean, like, if you can a landlord stomach an extra £2,000 or £3,000 or £4,000 for a transaction, they probably can in most cases if the numbers stack up. But can at £1 million, can you stomach an extra £30,000? Well, look, you probably can afford to if you're buying at that price point. But do the numbers stack up? I'd say in most cases probably not.
Yeah, fair enough. There also seems to be quite a strong appeal against that stamp duty premium at the moment. So far as I was reading the other day, the government's actually raised quite a bit more than they expected. So maybe, I don't know, who knows, but maybe there's a change on the horizon for that.
The government seems to like changing it to do every other week. Well, not every other week, but every other budget is a new thing on the property market to try and slow it down or to create a new headline. And it is a fantastic headline. I think some people have built up portfolios over a good number of years, 10, 20, 30 years, and they've created wealth and created a small business for themselves. And there's probably a little bit of anger with those people who've spent some time and money and years of building up this wealth to suddenly be hit hard by it.
It'll be interesting to see if there are any further changes to property, especially with Brexit and everything on the horizon. I'm sure Parliament's probably pretty busy.
I'd say so. It's absolutely, yeah.
Okay, so we've covered there the 3% stamp duty premium. We also mentioned the changes to mortgage serviceability. So banks making sure that people are very much stress testing their portfolio lending, not necessarily portfolio, any lending. I suppose that's affecting, lower yielding properties.
It is, yeah. I mean, there've been a large number of changes, probably over the last 10 years, since 2000, back in 2007 when the credit crunch happened. And there have been a large number recently in the last 6 to 12 months again. It's making sure that there really are, if the crash were to come again, making sure that there is enough serviceability there so landlords can cover themselves.
Yeah.
So it's the lower yielding properties again, the ones that just washing their faces that are really being hit again most. The large deposits need to be put in there just to make sure that lenders are happy to lend on that particular property.
Yeah, and I suppose that's kind of restricting the level of lending on lower yielding properties as compared to before. I think there's potentially a bit of a risk there for people who have been borrowing higher amounts on lower yielding properties in the past that potentially won't be able to borrow as much as they could in the past now.
Yeah, very much so. I mean, I remember when I bought my first buy-to-let property 13 years ago. You put down a 10% deposit. The rent had it was 125% at current interest rate, and away you went. And it was fairly easy. Now it's a minimum 25% to get a half decent interest rate, and the tests they do, are quite strict and quite rigorous. So yeah.
Okay. And finally, we spoke about that final change, which was only just the 30th of September, so very, very recent. With regards to the way that lenders look at portfolio landlords, so those with 4 or more properties. It's probably too soon to see how that's affecting things, but how do you think it might affect things moving forward?
It's a good question, and one we don't know the answer to yet, but it's certainly, I would imagine it will have an effect of some sort. And like you say, we're only 3 weeks into it, so it's difficult to say just what's going to happen. But it will certainly, the way people structure their, how they purchase properties will certainly have, you imagine they'll probably get slightly creative, and where they bring in family members or husbands, wives, buy and sell it in different names, or what they do it'll be interesting to see.
I think overall it kind of makes sense. The fact that lenders are now looking at a portfolio landlord's whole portfolio rather than just the property they're lending on.
I guess it is common sense, and if someone's portfolio is performing well, then you're happy to lend, and if it's not, one or two is not performing so well, then you take that into account as well. Look, it is common sense, but it's obviously just new, and therefore.
And I think with anything, when changes like this come into place, it's quite important for landlords not to overreact to the outcome.
Yeah, absolutely.
Because certainly that final change we're talking about there, it seems a lot more straightforward than a lot of people I've been speaking with sort of are perceiving it.
Yeah, I think with any change that ever comes in, it normally takes 6 to 12 months just to bed in and settle down, and it's worth just sitting, taking a back seat, and just seeing what happens in the market, seeing what the lender's response to it are, seeing what the investor's response to it are, and then making a judgment call from there. Now the market nothing may happen, but maybe 1 or 2 things will happen, and also within that time period, 1 or 2 bits of new legislation may come in as well. So it's working out to see whether something comes in from there.
Okay. All right, so we spoke about the 4 changes. A bit of extra tax for some landlords with high borrowings, a bit of extra stamp duty for some as well, and more to consider from a borrowing perspective. Now, how do you see that impacting the UK property market?
It's a good question as well. Again, when I first started in the property market 13 years ago, the focus was London, and it always generally had been. You'd buy in London, the yields were okay, never amazing, but okay, and the capital growth forecasts were always fantastic, and they always have been. London's generally doubled in value every 8, 9, 10 years, even through the credit crunch. You choose a 10-year period, and it's doubled in value. And it's moving away from that now, I'd say. The capital growth forecasts aren't as strong as they were due to Brexit, due to the election and the uncertainty around that, on those 2 points, and the yields just being so low. The yields at the moment, on average in London, are generally between 2 and 4%. Now, there are obviously anomalies outside of that, but generally it's between 2 and 4%, which means you need to put so much money into a particular unit for it to just wash its face. So if you're putting a couple of £100,000 into a property and spending 30, 40, £50,000 on stamp duty, it's a £250,000 just for a unit to just wash its face a little bit more.
Yeah. Okay.
So therefore, people, in my opinion, are going to start looking outside of these areas, whether that be student towns or whether that could be areas that are outside of there, where they're regeneration areas, or potentially areas up in the north of England, where there are lower value properties, higher yielding assets, and with stronger capital growth forecasts.
Well, I suppose if you're getting the higher yield and the lower value, a little bit of extra tax doesn't hurt you as much because you've got more of a buffer. You're buying a lower value, so the stamp duty doesn't hurt as much, and serviceability doesn't become an issue either because you've got the higher yield. So I suppose that kind of makes sense. Thanks very much for that, Ben. Lots of value information there. That's all the time we've got for now. Join us after the break for more of a discussion on specific locations and how you can actually take advantage of some of these changes in the market to benefit you as a landlord.
Proper Wealth, brought to you by the best of buy-to-let.com.
At Best of Buy to Let, we do the research and due diligence on the UK property market for you to ensure that you make the best possible investment. Our properties are researched, backed and risk mitigated to allow you to make a stress-free purchase. Our team of qualified experts identify the best of market and provide a turnkey solution. Contact us today for your free recommendation on how you can improve your property portfolio and achieve your goals in the current buy-to-let market.
Welcome back to Proper Wealth with me, Paul Mahoney. Joining me is Ben Wilson from Best of Buy to Let. Thanks again, Ben.
Thanks, Paul.
Before the break, we spoke about the UK property market, some of the changes that are happening and how it's affecting the market in general. Now we're going to talk about some specific locations, areas that are being hurt and areas that are actually benefiting. So, Ben, if we start with the areas that are being hurt by these changes, can we talk a bit about that?
Sure, I'd say the biggest one that's being hurt is London. When you were investing many years ago, when I first started investing in property, the premier location you'd always think of is the capital of the UK, where the city is, where Canary Wharf is, where the West End is. It was a safe place to invest. Capital growth has always been strong. The yields were good, and that's where you'd always sort of lean towards. And I'd say that's probably where it's been hurt most. The prices are now so high, the entry point is so high that the stamp duty bracket, the stamp duty you're going to pay is incredibly high. The rents haven't stayed at the same pace that property prices have, so therefore the yields are so low. And the capital growth forecasts just simply aren't as strong as other places within the UK, due to Brexit, due to the uncertainty with the city because of the election and Brexit, and other factors as well affecting London.
Yeah, okay. So the higher values, the lower yields, and I suppose it's interesting how that happens, isn't it? Because rents are so closely linked to incomes, no one borrows to pay their rent, and therefore rent can only go so far beyond income growth, whereas everybody borrows to buy property in general. And therefore, I suppose property prices aren't really linked to incomes, are they?
They are in a way, but I guess people will push themselves, will stretch themselves because it's an investment as well. Yeah. But also, whereas you're only ever going to rent one property, some people may own 2, 3, 4, 10 properties because you're buying a home and then you're buying a various number of investment properties, and therefore you'll stretch yourself to buy those properties, whereas you're only ever going to rent one property per household, say. Unless you want a holiday home, for example, but the chances are you're going to have one rental property per household.
Yeah, okay. So the fact that we've got the higher values, I suppose that's being hurt by the change. The lower yields is also being hurt by the changes. London being the safe haven, historically anyway, how are you finding that people are kind of perceiving that? Is that something that everybody understands, or is it a growing level of awareness?
Yeah, it's a good question. I think that some people are very, very aware, and some people are very, very switched on and aware of the changes that are happening, and the thinking being that they need to look outside of London. Some people are still very much fully focused that London's the place to be, and haven't quite got their head around the fact that actually probably outside the capital is the place to be now. They just think that London, can't go wrong, and it's the place to be. But I think the proof will be in the pudding in a few years' time, when if you have or haven't invested outside London, and how that's affected you.
Yeah, okay. And I suppose high level people might still be thinking London's a place to invest, but perhaps when it comes to the logistics of actually buying, how much cash they need to put in, the level of borrowings they can actually get, the stamp duty they're going to have to pay, and whether that property actually washes its face after all of that.
Yeah, exactly that. I mean, when you invest in London, so when I first invested in London years ago, you put in 10-20%, and now you need to put a minimum 25%, and that's before we've got to serviceability. And as a generalisation in London, you need to put in about 50% there and thereabouts. If you're buying something at about £500,000, which is going to get you a one-bedroom flat in most parts of London, and not even that in some parts of London, you're putting in £250,000 before you've got to stamp duty and before you've furnished the flat and any other surveyor's fees, solicitor's fees, and any other fees. So we're looking at £300,000 plus just for a property that washes its face. In other parts of the UK, you can buy 4 or 5 properties with that money with leverage. And therefore, if you're buying 4 or 5 properties that are going to make money versus one that's not going to make money, if you're putting those numbers into a spreadsheet and comparing the spreadsheets, common sense tells me that London at the moment probably isn't the place to be.
Okay, all right. So we've spoken about London and the South East being hurt. You've just pointed out there, that there are other areas that potentially are benefiting from these changes, or the shift that's occurring in the market. Where do you see that shift going?
That's a good question again, and we're seeing a lot of the shift going up north for various reasons. There's the new HS2 and other regeneration projects that are going up north.
Yeah, Northern Powerhouse schemes overall, I suppose.
Northern Powerhouse in general, exactly. And if we're looking at specific locations, we're probably looking at Manchester and Liverpool as the main two. Manchester's benefited hugely. Liverpool's probably just behind that, but we see it as having similar infrastructure to Manchester. I think that it's probably got a lot of way to go. So probably those are the two main areas that we see in terms of the areas that we're seeing where people are investing.
Okay, so the focus is shifting from London and the South East previously being the focus, more so toward the north and predominantly the northwest, from what you're saying there. Places like Manchester and Liverpool. Exactly
that. I mean, if you look at the typical flat that you're buying in either of those two areas, you've got a low entry point. You can pick up a couple of 2-bedroom flat for between £200,000. So therefore, the stamp duty you're paying is nominal in comparison to what you're spending in London. Also, the yields are much higher. If we're generalising again, we're looking at yields between 6 and 8%, which means that the serviceability is much higher, and mortgage companies are much happier to lend you money, and also lend you money in a couple of years' time if you want to refinance, if the property's gone up in value. It makes life a lot easier for getting your money back out and putting it into another investment, whether that be property or something else.
So this shift kind of makes a lot of sense, doesn't it? If you can earn a similar amount of money in the north, whether it be Manchester or Liverpool, and have much lower living costs, and buy a nicer property in a nicer location, then why wouldn't you do it?
Absolutely. Look, you can afford to live in the north these days and earn a similar amount of money, or even less, than London, because the living costs are so much greater living in London. The cost of rent or mortgage, the cost of land, and everything else alongside it, whether that's a gym, whether it's a car, everything tends to be much cheaper up north. And then from an investment point of view, it just tends to make more sense going up the north at the moment. Now look, I love London, but from a numbers point of view, it makes sense to go up north from my point of view at the moment. Now that's not to say it's always going to be that way. It used to make sense to invest in London. But moving forwards, for the short term at least, I would suggest that it makes sense to go up north.
Okay, so we've spoken about the north there in general. We've touched a little bit on Manchester, absolutely bustling city, so much happening there. All the kind of fundamentals that people generally want to look for when it comes to property investment. We mentioned Liverpool as well. Now, something I've found quite interesting is Liverpool, because I think perception-wise, a lot of people think of it as as there's not really much happening there.
Yeah, that really isn't the case at all. We were there only a few weeks ago, and you walk around the city, and again like Manchester, it's buzzing. You walk down the quays, there's loads of regeneration going on. You walk around the city, it's quite a small city, Liverpool, but lovely. There's building work going on all over the place, some beautiful buildings, some really old architecturally stunning buildings, like London has. And it's really on the up, and really on the up.
Some of the numbers, some recent reports on Liverpool, so far as it being the fastest growing city for employment growth, and also the fastest growing city for economic growth. The economy there grew by 15% last year.
Yeah, and
which is pretty incredible.
Yeah, it really stacks up. It really does, and we can see why the capital growth forecasts are strong there as well. Just with the businesses that are there, the businesses that are moving there, and the growth that's happening there as well.
Completely agree, Ben. Also, infrastructure spending in Liverpool is pretty impressive. They've got massive amount of infrastructure going on. The Peel Group is doing 2 very large infrastructure projects, which are mixed-use, commercial, residential, retail, which will probably double the size of the city in Liverpool. As you say, at the moment it's a relatively small city, but it's expanding to the north. It's also expanding across the river, which will be really interesting to see how that plays out over the next 10 to 15 years. I suppose on top of that, it's about 20 to 30% cheaper than Manchester and Birmingham.
Yeah, it really is.
From a capital price perspective.
It is. I'd say at least 20 to 30% cheaper than Manchester and Birmingham, which means the yields are slightly higher, just because the rents are a similar amount, but the prices are cheaper. Which means your entry point is cheaper. And I think just touching on what you just said in terms of the infrastructure spending that's going on in the north and the west, we really are seeing that the centre of Liverpool is getting further and further north, just with all the infrastructure projects that are the spend and the regeneration projects that are going on in the north of Liverpool. You take a walk around, and it's 10 years ago it was pretty grotty again in the north of Liverpool in parts. But you have a walk around there now, and you can see that the changes are happening, and see how fantastic it's going to look for not too long a pace of time.
Yeah, so it's almost a bit of a 2-speed market, isn't it? We have London in the southeast cooling off and plateauing a little bit, and I think a lot of people, especially those that live in London in the southeast, just assume that's the case UK-wide, but it's really not, is it?
No, it's not. If you look at the stats, the north of England really is doing well. Hey, look, it's not booming by any stretch of the imagination. We're not in a 2006, 2007 market, but it's a steady growth. It's performing well, and we expect it to continue to perform well. Steady growth is probably the best way to have it, rather than you really get peaks and troughs. So we're in a steady market at the moment, I'd say, whereas London, like you say, is plateaued slightly, and especially at the higher end of the market, £1 million plus, it really has dropped off and really is slow, and it really is tough to sell your property at the moment if you're above £1 million.
Well, there we go. I think that was a great description of what's happening in the current UK market. Thanks very much for your time, Ben.
Thanks, Paul. Thanks for having me.
And thanks very much for joining us on Proper Wealth. Join us next time for more discussion on wealth creation.
Proper Wealth, brought to you by the best of vitalet.com.